Well, everybody, welcome to Wall Street Hackers, one of the most popular programs on the Pod TV network. And we do want to thank all of our viewers who are moving on from the chess show that shows right before this, which there were some very interesting comments on the LinkedIn pages regarding that. And of course, the thing is, in this show, we will discuss the latest in market trends, dealing with the stock market, the economy, and Peter's picks, things that you can do, plus stories of the week we're going to look at, in quotes of the week, and a quick panel discussion, all in 30 minutes, faster than any movie. And with that, we do have the hacker himself, who has a degree in economics from UCLA, a law degree from the University of Miami, and an MBA from NYU, spending 17 years working and toiling in New York City. Let's bring in the hacker himself to tell us what the markets are doing, Peter Bennett. Peter, welcome to your show.
I prefer not to consider it toiling. I enjoyed the time there, but thanks.
You enjoyed the time toiling there. Okay, that's fine.
It wasn't toiling. I mean, I always enjoyed my jobs there, like except for maybe 6 months. So that's another whole story. So welcome everybody to Wall Street Hackers. You can see a new episode generally every Thursday or Saturday, depending on which distribution network you tune in on. So we always start with the markets, and there have been a number of interesting developments in the market. First of all, U.S. job openings fell under 9 million this week. And that is very different from the norm because it's been over 10 million for a long time. And that's actually a 2-year low. So that's a sign that maybe the Fed is starting to make a little progress. Unemployment is now in the U.S. is now 3.9%, which was above the recent lows around 3.4%. But on the other side, those were historic 50-year lows. So, it is some progress. On the other side, we're far from the Fed's 2% inflation target. And the question will be, what will it take? And that will be our panel discussion of the week. Does the panel think we're heading for a hard landing, a soft landing, or no recession at all? And I have a pretty firm opinion about that, but we'll get that later. So the thing is, though, if anybody thinks, unemployment and employment, are pretty much resolved because it's starting to go in the right direction. The Atlanta Fed just put out numbers, I believe it was this week, that said that the average for 3 months wage increases was 5.2%. So that's not necessarily like inflation is under control. It's the exact opposite, really. We're talking about a long way to go. It was down from 6.5% from a prior period, but that is not under control. So we probably have ways to go. The second interesting development, and those who are in the market would have known this for sure, is bond yields really took a big dive. I believe I read that the drop in bond yields recently was the most rapid drop in 20 years. And I noticed it because I went to maybe look at a muni bond, and it was wow, the muni bond market has changed. It's hard to get a full state muni or as long a duration in there. But the other side is treasury bonds really fell. So I think it was just 4 weeks ago, maybe 3 weeks ago, on one of my shows, I was saying you should consider really long duration treasuries because they were paying 4.8%, maybe a little higher. I think it might have hit 5 at one point, but I would say that's a pretty good rate even against the expected market returns, and it's secure money. So I personally loaded up my 401k and bought some in my Roth IRA, and so far it looks really good because I remember just 2 years ago, it was such a struggle to get any yield at all. It was like, okay, let's look for, take a 2.5% muni or, very low treasury. So my guess is that rates are going to head back down, certainly in the next few years, because that's one of the main theories of my show. One of my main theories that's so important in planning your portfolio is that bond yields are going to fall to almost zero, and interest rates very low in terms of what the Fed is controlling. And the reason, and maybe negative, and the reason is because the government of the United States and the governments of the world, which have scary unfunded liabilities in terms of healthcare and pensions and retirement plans, depending on the country. I've looked at countries all around the world, and they're all not planning for what's happening, a demographic tidal wave in terms of people aging. And they were supposed, for instance, the United States was supposed to have put this money away for Medicare and Social Security, but they've been spending it every year. So what's going to happen is the governments of the world are going to be printing money at an unbelievable pace in order to meet these unfunded obligations, not to mention the funded obligations. For instance, the United States has 33 trillion on the books already, and it keeps growing. These are almost unfathomable numbers and certainly unprecedented in history. So basically, the governments are going to say, we cannot afford to pay any interest on this, or would prefer negative. And that would be the perfect scenario for the government, at least to begin to handle this major issue. Because if we have negative interest rates or zero interest rates and inflation is 4% or 3 or 2 or whatever it is, it will eat away at least some of their debt and obligations. But it won't necessarily make for a very healthy investment opportunity environment, depending on, how you choose your investments, obviously. So the key point there is the government's going to use yield curve control of the world, very likely. And so we have to think about that macro environment in the future. So this fall, maybe we'll see if they go higher again. But even at 4.3, it's probably not a bad bet. But at 4.8, to me, it looked like a no-brainer. So for a long bond like the 30s or the 20s. The third pretty significant point is that so when bond yield dropped, the market should have been ecstatic about that. Wait, it won't charge, companies won't have to pay as much for interest now, and it won't hurt so many companies, especially companies that are heavily financed. Their loans will be coming due, and now it will help the company. So this should have been very good news. Plus, it reduced the alternative to the market. But the market's been flat. As a matter of fact, the S&P 500 has been essentially flat since July 23. The QQQ, which is basically NASDAQ, a lot of tech in there too, and that's been essentially flat. So basically, the market's gone nowhere since July. Now, it had gone up a lot, but also if you look 2 years back, for the last 2 years, the market's basically done nothing too. So we've had a flat market for 2 years, flat market for 6 months, and it's critically important to plan, again, against what macro environment you expect to come up with, and we'll be discussing that again in the panel discussion of the week. So nobody can really guess what the market itself will be doing in 2024, but my best guess, and we'll be getting into it, the reasons why, is pretty flat market for the year. So we'll talk about that after the break. So next, quote of the week. I usually pick a quote of the week that comes from, reliable source, and I'm not saying this one isn't reliable, but basically, I always use articles. This is the first time I ever used a letter to the editor as my quote of the week, but maybe because I agree with it, certainly that's part of it, and also because I was impressed with it, I'm going to read you a letter that was posted on Barron's.com. There is a belief that the Federal Reserve will cut interest rates soon. The only way that will happen is if we are in a recession next year. If that happens, the market will probably tank. Otherwise, there will be a long time before the Fed cuts, and it may even make a hike. We have a presidential election next year, and usually the Fed avoids making any significant moves that may affect the outcome. And, that sounds right to me, but we will see what happens. But I think the Fed's going to move slowly in any case, in general. So 5 most interesting stories of the week. Segment number 1, jailed Russian opposition leader Alexei Navalny was hit with new charges by the government of Russia, and this time for vandalism. Navalny is 47 and is already serving more than 30 years in prison after he was found guilty on charges that he and his supporters say were politically motivated. He already had been handed 3 prison sentences and faced months in solitary too. Well, my point is, I am certainly glad this could never happen in the United States. A presidential candidate could never be brought up on multiple charges, and especially not 150 multiple charges. After all, we have a democracy, and this could never happen in democracy. What a relief. Second story of the week. I try to throw a little humor in there anyway. Second story of the week. A U.S. Navy destroyer and 3 commercial vessels came under attack Sunday from Iran's terror outfit in Yemen, while Iranian proxies resumed attacks against military bases in Iraq and Syria. So there have been at least 74 attacks on U.S. troops in the Middle East. And that's just since October 17th. And it doesn't count these attacks on the ships. The attacks were done with drones and missiles. So my only footnote there is it's my guess that President Biden is reluctant to take any action at all because we're heading into a presidential campaign. So if he did take action, well, 1, he could be accused of starting another war, which it would be, or 2, it could certainly elevate oil prices, which would again hurt his chances. So other than that, I really don't understand how people can send missiles and drones and attack U.S. military, and pretty much not much happens. Number 3 most interesting story. According to the ISO New England, which regulates power across the Northeast, regional electricity demand will increase by around 70% by 2040. 70% increase in the Northeast by 2040. Eversource, which regulates a lot of the northern states, including Connecticut, expects their demand to increase 150% by 2050. The second point about this is in the article is supply is not keeping up with demand. Proposed wind farms are suffering major cost overruns of over 50%, on top of the fact that the price of the original wind contracts was already more than twice the wholesale cost of electricity. What does this mean? Well, a few points. 1, the cost to consumers of these green options and the plans and the restrictions on natural gas pipelines in the Northeast are likely going to drive the cost of electricity up a lot higher in the Northeast. And New York particularly is going to get slammed, by the way. We discussed that in other shows, but they're about to be slammed. I mean, huge increases in the next 2 years because of the economic policies relating to energy. And the other thing is the whole strategy on the environment is terrible because they're not only hurting the economy dramatically by raising electricity, which causes, of course, a lot of inflation costs, but also they're actually not only not doing the right thing for the environment, a lot of their strategies in place are hurting the environment in many ways. And that's been discussed a lot in prior shows, but really bad strategies. So even if you were just concerned about the environment, you would not be happy if you realized. And one example is world carbon is up in 2022 and in 23 over prior years, both in the US and worldwide. So what exactly are they accomplishing? It's the exact reverse. Interesting story number 4. Last year, 91,000 New Yorkers relocated to Florida and 31,000 moved to Texas. But Florida is not perfect, and neither is Texas, I imagine. And and I love Florida, visit sometime, but Florida is not susceptible, obviously, as we know, to natural disasters and hurricanes, as is Texas. So Floridians are now paying an average of $6,000 a year for home insurance. And that is 42% more than the average in 2022 and for the nation. And then that's also an 11% increase nationally, but it's a huge jump for Floridians. In Texas, the cost is also among the highest in the nation for home insurance. And then again, because of storms and everything. So it's explicable, but people might think, oh, I'm going to save taxes, but they might lose a little bit on insurance for sure. Final story of the week, and I'm always interested in Disney. From an investment standpoint, it's interesting too, although I would never touch Disney stock. And I'm going to explain why. So Disney has especially recently attracted the interest of a number of investors, activist investors. And Bob Iger, the CEO, is trying to steer the company clear of a very turbulent period. And he recently said that the keys are streaming, theme parks and cruises, studios, and ESPN sports. Well, we know that ESPN and studios have been suffering a lot. A lot of their movie ratings are now even worse. A lot of people aren't going to the Marvel movies. But these investors, and what anybody has to consider is that there's an American Heartland theme park going up in Oklahoma, and it will be built in 2026. It is a Disney-sized park that is being built by former Disney builders, and it's got a big budget. So considering that Disney has a lot of issues and complaints from consumers and unhappiness due to their highly escalated prices, their political forays, which have upset many people, especially in their base, and 3, there's some dissatisfaction anyway with lines and things they've tried to do to jack up their revenue on the theme parks to help with everything else. So, but here's the thing. A lot of their consumer base is in the Midwest, and a lot of those people might say, wait a minute, I'm going to take a drive to the American Heritage Park, if it's as good as I expect it to be, and I don't need to go to Disney and pay these unbelievably high prices. And then maybe in the winter, I'll go to the Caribbean, or I'll take another Florida vacation, or I'll go to Mexico, or wherever, to a warmer climate and save a fortune. So this is a coming threat to Disney's remaining successful and monopoly franchise. So we will see what happens, but there's a lot of danger there for Disney coming up in 26. So we'll see. We'll take a quick break, and then we'll be on to the pick of the week and also the panel discussion. See you soon.
One of the things that business owners forget a lot is to prepare for their own retirement.
Hi, my name's Nick Palavita, and today I'm with a very special guest, a certified financial planner, a chartered retirement plan specialist, and president of National Pension Partners, Max Culiet. Max, tell me what you do at National Pension Partners.
Well, Nick, we help successful small businesses and professionals put together retirement plans that provide them the maximum retirement benefits and big tax deductions at the same time.
Well, how do you do this?
Well, we get on an internet conferencing system with the client. We review their goals, what they want to accomplish, and then put together strategies to help them in implementing a retirement plan that benefits them, not everybody else.
Well, that sounds really good, but how much does this cost?
Well, it's really not bad because the first consultation is free. That allows us to go through and discover whether this strategy works for that business and for you as the business owner, and helping you maximize your retirement.
Well, Max, how do we get this free appointment?
It's really pretty simple, Nick. You can either go to our website below or call us at 877-252-1692, and then we can set up a time with either myself, Nick, or one of our other retirement plan specialists, another CPA or advisor in the office, to go over this with you and make sure it fits you.
Hi, my name is Lewis Haupt. I work with National Pension Partners, and I work with businesses to allow them to put the maximum away that they can for themselves and to save taxes.
Hi, I'm Brad Coyle, and I'm the brokerage manager at National Pension Partners. We're always analyzing plan fund choices in order to ensure the participant's success.
If you want more information on how we can help you and your business put more money away in a retirement plan than you ever thought possible, contact us at the website below or call us at 877-252.
And we're back. So what to do, as always, I say you will always want to own some energy in your portfolio, at least, if not a lot, especially pipelines. That's the place to be. And we've talked about that, on so many different shows. Own dividend stocks for the amount that you want to own stocks. Our 50-year chart up to 2022 shows that dividend stocks outperformed the S&P 500 by about double over 50 years. And dividend growth stocks and initiators actually did triple the S&P 500. So whatever allocation you pick, you want to own dividends. And there's other reasons to own that, especially if we're heading into a 0% environment. And finally, be cautious in 24. Nobody can predict what's going to happen, which gets us into our disclosures. But basically, there could be a very rocky road ahead for the market. And we'll be discussing that too, to a point. I'll tell you my conclusions. So disclosures. Hey, Nick, we'll have you on in a minute, but you can write it out for the panel discussion. Disclosures. So it's an entertainment only, no guarantees. Nobody can guarantee anything. If they say they can, they're probably not telling the truth unless it's a CD, but then you have inflation risk. It's only our opinions, and consult your financial advisor. So basically, for 2 years, I've given an investment pick of the week, sometimes repeated it if I up the allocation, but this is the first time I'm ever going to do something which is a non-investment pick, which is something I won't touch. Now, so that's the first point. I do promise next week I'm going to mention one of the first mutual funds that I put a small allocation in among two mutual funds, and I haven't done that for a long time, but I like the risk-reward ratio. But for this week, we're discussing cryptocurrency and especially Bitcoin, and there's two main points. The main point is crypto, any crypto and Bitcoin could go to $1 million or 100,000 or zero. It's very volatile, but this isn't the type of investment I want to get into because I don't like going to Vegas and betting on red and black. And I don't want to get involved in something that's driven purely by consumer sentiment because it is totally speculative. It is one of the most speculative things I've ever known or seen. And I'm going to get into a list of reasons why I think that's so. But again, I don't know. Don't listen to me. If you want to bet it's going to 100,000 or a million, it could be right because it's basically like a meme stock. It can do anything. It's just not my investment philosophy, and you have to be careful if you do use that philosophy for sure. So here's all the reasons why. First of all, 2 years ago on our show, we talked about the fact that there were then 7,000 cryptocurrencies. People may not realize that. Last year, there were 12,000. I just looked it up, and as of March 23, there were 23,000 cryptocurrencies. So basically, people are just saying, I'm going to create my own money. This is sort of out of control. Number two, the governments of the world should have stopped this a long time ago. A functional monetary system cannot allow citizens to create their own money. It devalues the money, and two footnotes about that. One, this could even be an additional source of inflation since people are printing their own money. And two, it's also terrible for the environment because the miners use a huge amount of electricity to do the mining. It's really a total waste. Number three reason why is crypto was created when it had unique characteristics. So when it was originally created, there was no tax regulations. It wasn't officially taxed, and there were no regulations about disclosure. But as of now, the U.S. government, I think about a year ago or so, year and a half ago now, passed rules that said crypto and other currencies, digital currencies, have to be reported and taxed. So where's the advantage of this over $1? I don't see it unless you want to use it for a game. The fourth reason is many countries have already developed, and some large countries have already developed their own digital currencies. And many more are developing digital currencies too. And I expect eventually the United States is going to develop their digital currency, which would be a real shock to Bitcoin. But I believe Canada already has it in some really credible countries. So the consumer has a choice. They can buy a crypto from somebody who they don't even know who it is, and if they're financially stable, and there have been scandals there, or you can buy it backed by a whole country. I'd rather have a digital currency backed by a whole country. Now, some people say Bitcoin is different because Satoshi Nakamoto, I almost laugh at this, but when you hear it, Satoshi Nakamoto, they say, has promised to never issue more Bitcoin. As a matter of fact, on a different show, when I was a co-host, we had a professor on who said, Satoshi Nakamoto said he will never issue more Bitcoin. Only a few problems here. Number one, nobody knows who Satoshi Nakamoto is or if he even exists. So I wouldn't count on that either. Finally, we look at some comments. So the late Charlie Munger said, sometimes I call it crypto crapto. It is just ridiculous that anybody would buy this stuff. I'm not proud of my country for allowing this. And as a matter of fact, I prepared all that yesterday morning, on this crypto piece. But then yesterday afternoon, here's what JP Morgan said. It came out in the news yesterday after I did this. JP Morgan CEO Jamie Dimon slams crypto at a Senate hearing. He said if he was in control of the government, he would close it down. Well, 2 points. One, I would do the same thing yesterday. And two, sooner or later, there's a lot of danger in crypto. So that said, bet on red or black, and maybe it'll be your color. Nobody knows in these speculative markets. So moving on, we have to hurry again. We always run out because we try to force so much into this half-hour show. Panel discussion. Will the economy have a hard landing, a soft landing, or recession? And for the first time, I have a conclusion. I've been wrestling with this for ages, although I felt it might go one way, but I think I have a conclusion finally. So quick background. The Fed has been fighting inflation, as we know, for 2 years. There's very few but starting signs of progress. Unemployment is still low. Energy will probably keep going up, as we discussed so much on the show. And world governments and the U.S. are still printing money. We're far off the 2% inflation. But this is the key question for 24. Recession, soft landing, hard landing, what happens? It's so important for your investment portfolio to have the right view on this. So, Nick, question. What will the economy be in 24? Hard landing, soft landing, or recession?
Stagnant. It'll be just like what we're seeing right now. And the thing is, I'm not really concerned about the short term, Peter. I'm concerned about the long term, which you mentioned. We mentioned all the shows. And that deals with our national debt, which makes it very difficult for us to maneuver if interest rates become the leading budget item of the United States of America. And I think Americans are totally unaware that if interest rates remain high, what will happen is you're going to write your tax bill, and all the money you wrote to pay taxes will be going to pay the national debt down or paying interest on the debt, and that's it. And there won't be anything. But my review of the federal government budget, and I'm working with David Walker on it every Monday, is there's unbelievable waste. I'm not going to say fraud.
Oh, I'm sure.
Abuse, but waste and things that are buried in the budget that really even shouldn't be there. And one thing you picked on was climate change. That's one of them. It's like the golden puppy of money given away with no results. And so what we need to do.
Let me just footnote that. I can see the arguments for and against. We've discussed that on the show. But even if you're for climate change, as I pointed out, don't waste the money. Don't make it worse, especially. So.
But I think what you're going to see this next year will be about like this year. There's nothing on the horizon that's going to pull us into a deep recession that I can see, or anything, and you're not going to see a big increase in the GDP either. It's going to be basically everything's going to be about what it was last year.
Well, that's so funny because we never really rehearsed this show, but you just came up with the same conclusions to a good, like 95% of the conclusion I have. But I have something very important that I finally figured out. But So you're right. I think generally the long term is a big concern. Number two, I'm not worried about interest on the end because I think it's going to go to zero most likely, unless they lose control, in which case everything's Zimbabwe, and outrageous inflation. But very likely they'll be able to control it by yield curve control. So I think there won't be interest, but the debt itself is phenomenal, and they're going to have to print money for Social Security, for retirement. Other countries have the same exact issues or even worse if they promise free healthcare for everybody, aging populations. But here's my key point. So number one, my guess is we will have a soft landing, not a recession, as you said, and not a hard landing. But here's where the market is wrong. The market is anticipating, really good days. The Fed lowering rates, everything's going to be hunky-dory, everything will be perfect. And, it's not, I don't think it's a chance it's going to happen myself. So, but here's the point that I want to add. I predict a soft landing, but a very long soft landing. So the Fed refused to raise rates high enough to really cause a recession or a hard landing because they're trying to have their cake and eat it too. In order to do that, and this is where I think they're going to keep steering policy. I think they have to do that because they're political or because this is just what they want. But they basically don't want a big recession and they don't want inflation to continue. So how are they going to do that? Well, if they just keep these mild policies in effect, which eat away at the economy slowly, and let's say the market goes flat, because again, if the market goes up, it's going to cause a big inflation issue. If the market goes down, it's going to cause a big economic issue. So, but let's say they just keep things flat. Well, in that case, they can almost have their cake and eat it too, in a sense, because inflation will slowly eat away at the value. So let's say the market does zero for the next 2 years or 3 years or even longer, and inflation's at 4%, just picking a number. You've just lost 12% on your money. So now the consumer is weaker, companies are weaker, demand is weaker. So effectively, they're just playing this very long game. And they've said higher for longer, but I always say not high enough for longer. So what they really could have done is just, no pain, no gain. They could have put the economy through some more pain and we could have gotten through it. But in the end, it's probably going to be about the exact same amount of pain. It's just going to be this protracted situation where we just stagnate, as you said, and it could easily lead to stagflation. So that's what makes sense to me. Just like driving rates in the long term down to zero is the only way the Fed can go, and the government, that's what they're going to try to do and probably succeed. They need to keep the market flat. So I'm even considering options in both directions. You could almost bet on it. At least I was looking at it. But in any case, the only clear point is whatever the macro situation is, you have to guess it right to really pick your investments. Because if you think it's going to boom, maybe, you're going with high flyers, high alpha and high beta picks. So if you think it's recession, then you need to be super defensive. But I try to find companies that will do well in both my expected environment and any environment. And that's tough to do. So we'll be back next week with another episode of Wall Street Hackers. Thanks for watching, everybody. And as always, as Kim always says, get healthy, get wealthy. We'll see you next week.
All right, we'll see you then. Bye.